Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We've cracked open a massive stack of sources this morning. We're talking everything from CNBC and Bloomberg to Reuters and Yahoo Finance.
A lot to get through.
A ton. And the mission today is really clear. Figure out why the big money has suddenly, it seems, hit the brakes on the most aggressive growth sectors in the market.
Right. This isn't just a little bit of selling. This feels like a comprehensive reassessment.
It is. It's focused on two critical questions. First, how much does this hypergrowth truly cost? And second, is the initial strategy even viable anymore?
That's exactly right. I mean, the almost blind optimism that drove valuations in AI infrastructure and, the pure EV race last year.
Yeah.
It's now facing the harsh, cold calculus of balance sheets and, regulatory reality.
So today, we're distilling those core fears driving this capital rotation, showing you why things like Oracle's debt and Ford's massive write-downs are actually interconnected signals.
They're all part of the same story. Exactly. We're unpacking three major movements for you. First, the AI infrastructure sell-off, the enormous debt piles, and the risk-reward calculation of the compute boom.
Then, the EV and robotics reality check. Ford's pivot is staggering, and the iRobot story is, frankly, a tragedy.
And finally, global market stress. We're looking at major structural shifts, from European bonds to these high-stakes corporate governance battles over critical minerals in Asia. It's injecting a lot of friction into the system. Okay, let's unpack this. Starting with the true cost of the AI arms race and why financing the boom has suddenly become the primary risk factor.
Let's start with the pain point. It's the companies that are, intimately tied to the AI infrastructure build-out.
Right.
Looking at the reporting across CNBC and Bloomberg, stocks like Broadcom, Oracle, CoreWeave, they had another really rough day on Monday.
And that's extending the deep declines we saw all of last week.
It is. It just feels like it has no floor right now. And it seems so counterintuitive. I mean, demand for AI compute has never been higher, right? But the market is focusing on the sheer financing required.
That's the disconnect. Specifically, we saw Broadcom slide another 5.6% on Monday.
And that was after an 11% slump just last Friday. Oracle dropped 2.7% too.
The core of the issue, really, is the return on investment, the ROI. Investors are now asking if the returns will ever justify the astronomical level of upfront capital spending.
So it's an infrastructure problem, just leveraged to the extreme.
Exactly. Now, to be fair, there is a strong counterargument. CNBC cited Wellington Management's Matt Withheiler, and he suggests the bullish side is that, and I'm quoting here, every single AI company on the planet is saying, if you give me more compute, I can make more revenue.
Which makes perfect sense on paper. If supply creates demand, the ROI should be there.
Yeah.
So if the opportunity is so clear, why is the market punishing a company like Oracle so severely?
I think the market just doesn't trust how they're choosing to finance this growth.
Right.
Oracle is really exhibit A for the financial stress in this sector. They've lost 46% of their value since their September peak.
46%. And why? Because they disclosed a massive AI backlog that requires this monumental spending.
Monumental is the right word. They plan to ramp up capital expenditures to $50 billion this fiscal year. That's a huge jump from their previous forecast of $35 billion.
And that's just the direct spending. The really alarming detail, the one that spooked the market, seems to be the off-balance sheet liabilities, the leasing.
Precisely. As of November 30th, Oracle had ratcheted up their lease commitments for data centers and cloud capacity to an unbelievable $248 billion.
$248 billion. And these aren't short-term, right?
No. They run for 15 to 19 years. And the speed of this increase is just staggering. It's 148% jump since August, just since August.
Wow. The market sees that as massive, massive leverage.
It is. To put that into perspective for you, Tumas Tunguz, a venture capitalist cited in the source material, pointed out that Oracle's aggressive leveraging has left it with a debt-to-equity ratio of 500%.
Okay, so for you at home, if you're not looking at cloud provider balance sheets every day, what does a 500% debt-to-equity ratio actually signal compared to their peers?
It signals extreme risk. I mean, debt to equity measures how much a company is using debt to finance its assets. A high number means high leverage.
And their peers.
Cloud peers like Amazon, Microsoft, Meta, Google, they all sit in a range between a very manageable 7% and 23%.
So 500% is. It's just in a different stratosphere.
It's in a league of its own. Even a company like CoreWeave, which is also tied to this GPU cloud boom, has a high 120% ratio. But Oracle's numbers suggest they're using debt in a fundamentally different and much riskier way to chase this growth.
And this financing issue is also hitting the hardware guys. It's creating a weird paradox for a company like Broadcom.
It is. Their CEO, Hock Tan, expects AI chip sales to double this quarter to $8.2 billion.
Which sounds like a pure win.
It does, but Bloomberg noted the margin squeeze is real because Broadcom is spending so heavily on server rack components and cooling systems to deliver these chips. Their CFO, Kirsten Spears, warned that, quote, gross margins will be lower for some of their AI chip systems.
So revenue is soaring, but the actual profitability of that revenue is getting squeezed.
Exactly. High growth is colliding head-on with high cost and monumental capex. And even Microsoft, which is arguably the best positioned here, can't escape this dynamic.
No, the scale of investment itself is a systemic risk for the whole sector. I think Microsoft is planning $80 billion in CapEx through fiscal 2025.
That's right. And then, of course, you have the reports of the proposed Stargate project.
A monster project.
The monstrous undertaking. It could involve partners like Oracle and SoftBank and cost anywhere from $100 billion up to $500 billion.
The scale is almost unimaginable, and that's where the skeptics' question comes in, right? The risk of overbuilding.
That's the phrase Yahoo Finance highlighted. The risk is that these companies are buying a Ferrari when a Prius would have done.
So the concern's pretty simple. What if AI demand growth slows down? Or if the tech changes and new models need way less power?
Then all that capital quickly becomes stranded or inefficient. It really questions whether deploying $500 billion in infrastructure can ever be agile enough to keep up with the pace of AI innovation.
Here's where it gets really interesting. This realization hitting the auto and consumer robotics markets that the initial pure growth path they chose was just structurally unsustainable.
And leading to incredibly painful write-downs.
The Ford story is a shockwave. Yahoo Finance detailed this massive strategic pivot away from large, full electric vehicles.
And shifting decisively toward hybrids and extended-range EVs, or ERVs.
And this pivot, this admission that the first strategy was flawed, is costing them a staggering $19.5 billion in special charges.
$19.5 billion, and $12.5 billion of that is hitting in the fourth quarter of 2025 alone.
A huge part of that figure is the $8 billion in asset impairment for their dedicated EV asset.
Yeah, and for you listening, asset impairment is basically a non-cash charge. It's an official acknowledgement that the value of those EV factories on Ford's books is now lower than what they paid for them.
Because they're not going to generate the expected future cash flows.
It is a formal admission of a strategic failure, plain and simple.
And it fundamentally changes their product line. The current F-150 Lightning is being canceled.
The next version will be an EREV, which, critically, uses a gas engine not to drive the wheels, but just as a battery generator.
They're even converting their big Tennessee EV center into a new gas-powered truck plant.
But the business doesn't just stop, it rotates. While the vehicle market zigs, Ford is zagging hard into stationary power.
Interesting.
They're launching a whole new battery energy storage business, repurposing those EV battery plants in Kentucky and Michigan to supply grid-scale utility and, importantly, data center customers.
So it's an elegant pivot, but it confirms the market just wasn't ready to profitably absorb the scale of pure EVs they planned for.
Not at all, and that story of strategic failure links directly to the tragedy, as CNBC called it, that hit the consumer robotics sector. iRobot.
The Pioneer, the maker of the Roomba, filing for bankruptcy.
And being taken private by a Chinese lender and key supplier, Shenzhen Pacia Robotics.
The former CEO, Colin Angle, did not mince words. He called the outcome profoundly disappointing and a tragedy for consumers, the robotics industry, and America's innovation economy.
And the tragedy here wasn't a product failure, it was a regulatory roadblock.
Tell us about that regulatory piece.
Well, the immediate cause of the collapse was Amazon's $1.7 billion acquisition of iRobot.
Right, that fell apart.
It fell apart in January 2024 because of intense regulatory scrutiny from both the EU and the U.S. Federal Trade Commission. Angle saw that deal as the only most viable path for iRobot to compete.
To compete against who?
Against the really aggressive, fast-growing Chinese rivals like Anker, Ecovacs, and Roborock. Once that regulatory door was slammed shut, the company was just financially stranded.
That's a perfect illustration of how external friction, in this case, global competition plus regulation, can just destroy corporate value no matter how good the original product was.
And the financial details are brutal. They owe creditors, including nearly $100 million to their new owner, PCA, and $3.4 million just to U.S. Customs for unpaid tariffs. And that connects us, I think, seamlessly to our final theme, this global friction and the regulatory flashpoints that are defining the macro environment this week.
Absolutely. Moving beyond single stock stories, let's look at the broader nervous system of the financial markets. Drawing on Bloomberg and CNBC reports here,
Let's start with the risk barometer, Bitcoin.
Bitcoin. It dropped below $86,000 for the first time in 2 weeks. It's trading toward its year's lows and is down about 30% from that October high of $126,000.
And what's concerning analysts cited by Bloomberg is that this time the selling pressure is organic.
What does that mean, organic?
It means it's not like past crashes that were characterized by massive forced liquidations. This is driven by persistent spot and derivatives positioning.
So people are just deciding to sell to reduce their risk.
Exactly. Which suggests a deeper, more persistent bear market sentiment is setting in.
Yet the crypto faithful are still trying to catch the falling knife. Michael Saylor's company acquired almost $1 billion in Bitcoin for a second consecutive week.
Right, but the critics are pointing out that this aggressive buying is largely funded by selling Class A common stock,
Which is equity dilution.
It's essentially diluting existing shareholders who may not necessarily want their equity turning into Bitcoin exposure.
Okay, shifting to fixed income. One of the biggest, most structural changes preoccupying bond traders right now is the $1.6 trillion Dutch pension system overhaul.
As reported by Bloomberg, and this is an enormous pool of European capital.
It is massive. So why is a change in Dutch pension rules causing global bond desks to staff up for volatility over the holidays?
Because the Dutch system is transitioning from a defined benefit scheme, which promised a specific payout, to a returns-based system.
And defined benefit plans had to invest in long-duration bonds to match their long-term liabilities. They needed that stability.
Exactly. They were loyal, massive buyers of long-term bonds. The new returns-based system means the funds need far fewer of those long-term interest rate hedges. They can invest more in riskier assets. So this turns a once stable, massive buyer into a far less reliable customer and potentially a seller.
And the market is already reacting to the anticipation of that shift. Betting on a steeper yield curve is now a favored trade.
It is. The move is already pushing 30-year Dutch and German yields to their highest levels since 2011. The risk is immense because of the speed and size of this shift, especially with low year-end liquidity.
The fact that trading desks are planning higher than usual staffing for the holiday period tells you how serious this is.
It really does.
We also have to address the immediate friction in global trade. China lowered its anti-dumping tariffs on European pork.
Yeah, that's a big drop. They were previously as high as 62.4% in temporary cash deposits. Now they're down to a range of about 5 to 20%.
And this easing comes after the EU slapped tariffs on Chinese EVs. So it shows that trade policy is just this constant lever of diplomacy.
And that geopolitical friction hits U.S. corporate financials directly through tariffs. CNBC reported U.S. Customs collected over $200 billion in new tariffs imposed by the Trump administration in 2025.
$200 billion. And the crucial point here is the uncertainty. The legality of these tariffs is being challenged in the Supreme Court.
Right, so if the Supreme Court rules them illegal, companies like Costco, which is actively suing the administration,
They could be entitled to massive refunds on that $200 billion.
which would be an enormous contingent liability for the government and a massive potential windfall for importers.
And this legal uncertainty ties into a high-stakes corporate governance battle in Asia over critical mineral security.
Korea Zinc. They announced a monumental $7.4 billion smelter project in Tennessee. This is a U.S. partnership designed to secure 540,000 tons of base metals annually and specifically diversify the supply chain away from China.
A critical national security objective for the U.S.
Absolutely.
But the news sent Korea Zinc shares sinking nearly 14%. Why the negative reaction to such a massive, strategically important deal?
Because the deal requires Korea Zinc to sell $1.9 billion in new shares, which gives the U.S. joint venture a 10% stake in the South Korean company.
And the existing shareholders don't like that.
The largest shareholder alliance, Yunpeng and MBK Partners, is challenging it in court. They view it as a maneuver by the chairman to solidify his management control by diluting their combined stake.
So geopolitical necessity is now creating deep internal corporate warfare.
It's fascinating.
Before we move to our final synthesis, just a couple of quick market structure updates. Tesla confirmed they are testing driverless robo-taxis in Austin without occupants. That gave the stock a 3.6% jump on Monday.
And NASDAQ is seeking SEC approval to extend trading hours to 23 hours on weekdays to accommodate global investors.
Right, following the NYSE getting initial approval for 22 hours.
And Bloomberg notes the key debate here is still liquidity. If institutional investors don't widely participate in those extended hours, the trading could become far noisier and less efficient.
Also, the rising UK unemployment rate, it ticked up to 5.1% in the 3 months to October, has analysts calling a Bank of England rate cut inevitable this week.
Yeah, that seems to be the consensus.
So what does this all mean? What's the core takeaway from this extensive deep dive?
I think this week is really defined by skepticism and reassessment. Investors are running two major pressure tests.
Okay.
The first is the quality of growth. The AI sector is showing that hyperscale requires hyper-leverage, which makes profitability and ROI far from guaranteed.
And Ford's $19.5 billion write-down confirms that the initial full EV strategy just failed the profitability test. It's forcing this incredibly expensive tactical correction back toward hybrids.
The second test is friction. Global liquidity is tightening because of structural shifts, like the Dutch pensions moving away from long-term bonds.
And regulatory and geopolitical decisions are inflicting specific, immediate corporate pain.
Yes. Whether it's the tragedy of iRobot's failure due to a regulatory block, or the direct challenge to Korea Zinc's corporate control based on a U.S. national security goal. It's all connected.
And that leads to this final provocative thought for you to consider. The legal fight over the $200 billion in U.S. tariffs and the corporate challenge over the Korea zinc smelter, they show that we are past the point where geopolitics is just a macro concern.
It's a micro concern now.
It's a direct, stock-specific concern. Trade policy and national security requirements are now directly influencing specific valuations and triggering these corporate governance battles. It forces us to consider the political map as a primary immediate financial risk factor for every investment decision.
Absolutely. Food for thought as we navigate this rotation. We'll see you all tomorrow morning with new headlines from major financial magazines.